Stagflation is occurring before your very eyes. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
Right, very important conversation today because the way we measure inflation, deflation, etc. is an important discussion, and I think there's stuff that people need to know.
Indeed. About a month ago, we did a show and we talked about house prices. In that show, I said we are headed towards stagflation. And obviously that announcement by me is in some contrast to in terms of Harry Dent. Now, what we described in that show about stagflation was it is a combination of low economic growth, higher unemployment, and in terms of rising prices. So
and underemployment, very importantly, right?
Yes,
yep.
Absolutely. Now, we saw this week a big flash in the pan by the mainstream media and by the Australian Bureau of Statistics talking about we have deflation. Now, some of our audience may say, well, if Adam said a month ago we're heading towards stagflation, how is it that we have deflation? And it's very important that in this conversation we actually break down because the CPI statistic from the ABS was highly distortive. It told a very false story. The mainstream media, I think, misled the public, and we have a couple of other metrics that we are going to talk to the audience about, which also supports my thesis of, in the next 18 months, we're going to see rising prices, not falling prices. And that is obviously, given that we're going to see unemployment increase throughout 2020 to about 9.5% in December, we could say that we are going through stagflation right now and probably to the end of the year at least.
Right. And it's worth saying, I think, John, here, we know that the CPI calculation, as reported generally, is understating for all sorts of reasons, right?
Yes.
And then there were some one-offs this time around, which has massively distorted the numbers.
So we have an article from the ABC. ABC yep. talks about that we have deflation. So the headline CPI number was that for the June quarter, CPI fell 1.9%, which is the biggest quarterly fall in the history of the index. Now, there was a number of one-offs which are related to COVID-19 and the lockdown, which were included in the CPI calculation that I don't think were particularly fair, but they did actually sort of highlight that there were a number of things. Now, first big factor was free childcare.
Yep.
Now, that was always going to be a temporary policy measure, and to my mind, to even include free childcare in the statistic, that doesn't really make sense because you're sort of not painting an accurate picture of where the state of the economy is. And obviously, we're now in August, and now parents are now paying for childcare again. So we're going to see a big increase in the CPI going into quarter three because everyone's now paying for childcare. So that was one. There was free preschool for New South Wales and Victorian parents. So this led to a fall in the cost of primary education, and that was a one-off distortive impact. And then there was the reduction in terms of fuel. And we were just having a chat off camera about the price of oil. So yes, the price of oil in the sort of February-March period did fall quite significantly, and that was partly due to a decrease in the demand for oil worldwide, but also it was the market that sets the price for oil was highly manipulated through the use of financial derivatives, yes. And that also pushed the price down. So even though that some Australians have seen cheaper petrol prices, I think that is a very short-term blip, and we'll see a recovery in oil prices, particularly as we go through 2020, because of the increase in fiscal and monetary stimulus, which is going to push up, I think, all commodity prices across the board.
Yeah, it's also saying on oil that at the pump, depending on where you went, regional versus major centres and across different states, the variation in prices were much more extreme than normal. Mm-hmm. So many people actually were paying a lot more than the assumed numbers in the CPI.
Uh-huh. So when we consider these three factors, so the ABS admitted that if you take these three factors that we just stated, the CPI actually increased 0.1 in the quarter, didn't fall 1.9. So that's obviously important. So technically, taking the three factors, we still had inflation, not deflation.
But of course, beyond that, there's another important factor, because the whole housing cost thing was also tweaked, wasn't it?
Indeed. So there is a page on the ABS website that talks about specific changes that the ABS made in terms of its methodology to account for COVID-19. Now, one of the things that they did do was they did reduce rents because of some of these rental agreements. That was, again, it is a temporary measure. So some people saw a reduction in rents because they cut some sort of deal with the landlord. There were obviously a whole host of situations where people did not pay any rent in the quarter, and they were able to do so because the state government said that it is illegal to evict during this pandemic. So those aspects, again, are a short-term temporary measure, which would have pushed the CPI down had COVID-19 not exist, and that is also a quite distortive impact as well. And we'll put up another article. Is we've seen, so we have had private insurers in healthcare. They have frozen their premiums for the quarter, and obviously most of the premium increases happened in this June quarter around April. But also we're seeing that young people are dumping private health insurance, and no doubt that's also having an impact on where premiums may go in the short term.
Yeah. Now, if you put all that together, what you can say is that that number is hardly reliable, and it certainly shouldn't have driven the number of headlines that it did, because, of course, all the headlines were talking about deflation, end of the world sort of stuff, right? And they really had got hold of the wrong end of the stick.
Oh, yes. So I've had a number of people... So I was putting out some things on social media today, and a number of people responded. I went shopping and I put out a couple of tweets about the price of cucumbers and the price of capsicums, and it looks quite expensive in terms of food prices. But people said, but one person responded, but we have deflation and prices are falling. And obviously some people have looked at these headlines and they've not taken a deeper look into, well, how did we get this largest fall in the CPI in the history of the index? So once you account for all of these things, we do not have deflation. We actually have inflation. Now, before we started recording, I was telling you about some of the macroeconomic theoretical frameworks that most first-year economic students learn. Is when you think about aggregate demand and aggregate supply, if aggregate demand falls, and we have seen a fall in aggregate demand during the lockdown, particularly in certain sectors of the economy, what you would expect to see is a fall of prices. So there'll be a fall in the quantity consumed, and there'll be a fall in prices. And so this is why, in the Keynesian framework, deflation makes sense when you have a recession. Now, in the 1970s, when we had stagflation, where we had a recession in the mid-70s because of the oil price shock, at the same time we had rising prices. This was the massive conundrum in the economics profession, because the Keynesian framework completely fell apart, and everyone's saying, well, that's not supposed to happen, and all the academics had to sort of a number of them, particularly from the Chicago school, said, well, all of these Keynesians were wrong because the real world data didn't actually support this aggregate demand, aggregate supply model. So obviously we have inflation. Now the question is, going forward, are we going to see more inflation, rising prices going forward? At the same time, we're seeing an increase in unemployment and compressed incomes, or are we going to see prices stagnate or go flat or even fall? And so my contention, and we'll go through some of the reasons why I think so. I think we're going to see prices going up. And obviously, one of the things we're going to talk about soon, and maybe perhaps you can make a bit of an introductory comment, is with your household survey, you are seeing very clear signs that the Australian people believe that we have an inflation problem in terms of ordinary cost of living pressures, as opposed to the official narrative of either low inflation or we have deflation.
Yeah, well, let's just cover that now. So my perspective is based on my surveys, and this is 52,000 households that I survey all the time. One of the questions I ask is, are you spending more or less than a year ago, right? And this is in real terms, so it's basically trying to get a relativity, right? And what is true of that is that almost all households are reporting costs are rising a lot faster than incomes, faster than what I paid last year, right? And when you actually strip that back and look, well, so where are the rises? It's actually pretty broad, right? So they talk about food going up, they talk about electricity and power costs going up, they talk about school fees going up, healthcare costs going up. So pretty much wherever you look, what they say is real world experience is that I'm paying a lot more than I was. And then they go on to say, well, I'm paying maybe a little bit less because rents are going down a bit and my mortgage interest rate costs are a little bit lower. But the other stuff that I'm paying for is more than offsetting that. So net, I'm worse off than I was a year ago.
Yes. And so we have a graph that comes from your data set. Why don't we put that graph up there?
Yep.
So you sent me this graph earlier today, and when I saw this graph, it was, I think, back in 2016, 2015, about 40% were reporting that their cost of living was actually rising more than 12 months ago.
Correct.
And now into 2020,
it's gone through the roof. It's nearly everybody, not quite, but nearly everybody.
Yeah. So I mean, can you just recall for the audience what the statistic is? As we
it's about 96 at the moment. 96%, right?
So 96% are saying that the cost of living, that's going up, and compared to where we were about 4 or 5 years ago, I think there's just a dramatic shift,
yes.
which smashes the narrative. In terms of that we have low inflation. And I want to make just this one point, Martin, is when I was working in Parliament in 2012-13 for the Coalition, obviously even at that point there was this narrative around low inflation because of the CPI. When the Liberal Party was doing its polling, particularly in key marginal seats, and they were asking about economic pressures, the number one economic issue that was highlighted by voters back in 2012-13 was cost of living. And to me, it says something that if the establishment and the politicians and the economists and the statistical agency says we have low inflation, and yet the people through political policy know we have a big problem with inflation, we have a fundamental disconnect between what is the experience of ordinary economic life in Australia versus what the statistics and the media narrative is trying to say about inflation.
Yeah, absolutely. And of course, it's all the understanding, isn't it, that the official CPI numbers and the way they're calculated, there's a whole bunch of methodologies in there. So, for example, housing costs are a quasi-rental thing, right? That's how they deal with housing. And they also have this thing about that, if you buy a new TV and you get higher functionality today, so therefore comparing it with the one you bought last year, that's cost you less, right? So all of those equivalence issues are in there. And by the way, this isn't just Australia. This is a global problem.
That's right.
All Western economies have basically fixed the way that they report inflation so that they're actually all the time, before COVID, reporting lower than reality, right? And think about that, John. What that means is that all of the central bank targeting of inflation between 2 and 3% is based on a myth.
Yes.
It's based on a stupid false number.
Yes.
It's based on something which is not connected with reality for everyday people. And that is a fundamental problem.
Yes, and one of the key points that the audience needs to understand is the manipulation of the CPI goes all the way back to 1998 when they removed land. So the cost of building a house has not gone dramatically up in the last 20 years, but what has gone up is the cost of land.
Yep.
And that is the essence of the housing bubble. And the cost of land has been taken out of the CPI, which means we had a low CPI for all of these 20 years, which allowed the RBA to have lower interest rates to allow the banks to issue more debt. So, and the key point on this one is, Martin, just to labour on the point, the RBA accepted inflation targeting back in 1992, 1993, but it only accepted the CPI as the mechanism to measure inflation targeting in 1998
Yep.
after they manipulated
After they changed it.
after they changed it. Why did the ABS take land out? Because the RBA put in a submission
Yes.
asking for land to be taken out. So the land issue is a fundamental flaw in the CPI. So that's point one. They did change they have what they call geometric price indices,
Yes.
and that has also led to an underestimation in terms of inflation, and obviously in terms of quality adjustments, what we call hedonic regression modeling, that has also been incorporated in there, and all of these things has led to a systemic underreporting in terms of inflation. So obviously the question then becomes is for the audience is, well, how do we know if we have inflation or deflation? And it really comes back to, so the pre-Keynesian understanding by classical economists is what is happening in terms of the money supply. And it goes back to our third episode from 2018, where we talked about, fiat currencies and in terms of the nature of money. So if you can see that the money supply is growing and is growing faster, you will see inflation. And when I say inflation, that is the definition of inflation. But that will manifest itself into higher prices, more cost of living pressures.
Right. And just to be clear, the reason for that is that you've got basically the same amount of goods that you want to buy, but essentially there's more money to buy them.
Yes.
Right. So that basically allows people to put the prices up. Supply demand. That's the sort of at its essence, isn't it?
Yes. If we go back to that particular program,
Yep.
we talked about purchasing power.
Yep.
And any time for the last 1,000 years, when you have a fiat currency, they always print too much, currency failure, hyperinflation,
Yep.
and you always have to reestablish the currency into something that people have confidence in.
Yep.
So just to go back to Harry for a second, Harry Dent. So when Harry talks about deflation, so in the pre-Keynesian understanding of deflation is, you have to see the money supply shrink. You have to see the total quantum of debt shrink. So if that was to happen, and that's genuine deflation, that's when the 40% fall in house prices, 40 to 80%, the banks get in trouble, and you have a deflationary depression. And obviously one of the reasons why I said in the show from a month ago that we'll see house prices fall but not collapse is because they're doing anything and everything to stop households from experiencing in terms of those defaults. So we'll have to see how that happened, where we go from there. But one of the key statistics which I think is fundamental to bring to the audience's attention is now the latest. So the RBA measures the money supply using a whole bunch of various metrics. The most broadest measure of money is what they call broad money. So let's put the statistic up on the screen. Now, the June number was only released last Friday because it was the end of month. And what we can see is that particularly in the last few months, we have seen a dramatic rise in the annualized growth of broad money. So for June of 2020, broad money is growing at 10.2% annualized. This is the fastest rate of growth since July of 2009. So we are seeing the money supply grow dramatically fast, the fastest in 11 years. And the key question here is that, so when you print a lot of money, it does take time to flow through to whether it's the financial system or it depends on where the money goes. And this is obviously a point that you'd like to make about now that we're printing all this money, where's it all going to go? So we'll have to wait and see where that where that goes. But what we will see is that there is here's even when people talk about V-shaped recovery or when we open up the economy, we're going to go back to normal. The reason why we can never go back to where we were at the beginning of 2020 is because we have a lot more government debt and we have a massive increase in terms of this monetary stimulus, and that is something we cannot reverse. We can't reverse unless if we have a huge deflationary depression. So there is no going back to pre-COVID. I think this graph really highlights that point. So we will see rising prices going through the end of 2020 as we see unemployment go up. And it's because we've increased the amount of money printing, not just in terms of nominal terms, but also in growth percentage terms. And obviously, how that will manifest itself in the economy is obviously key. And obviously the point you'd like to make is, well, where is that money going? Well, we'll have to see exactly in the next 6 months, where is this money going to flow through into the economy?
Right, well, there's two observations there. The first is, why has money supply gone up? Obviously, JobKeeper, JobSeeker, people pulling money out of superannuation funds, all of that sort of stuff, right, is all part of the flow of money, right? But the key question is, where is it going to go, right? Because if it's going to chase goods and stuff in the shops, then prices definitely will rise. But it could also, like in the US, where the Fed has printed more than $5 trillion over the last couple of years, right? And 85 to 90% of that has gone directly into the financial markets. And it's gone directly into companies buying back their own shares by issuing corporate bonds, right? So all of that stuff's going on. Right? So that's the fundamental question. We need to watch now to see where that money flows to, right?
Yes.
Because if it flows in one direction, then your scenario is dead right. We're going to get stagflation, all of that. If it goes back into the financial system and it gets sucked into areas that effectively doesn't spill over into everyday prices, you could actually have deflation. Don't know which it's going to be. You and I probably have a slightly different opinion as to the probability and likelihood, and we'll probably come back to that in a separate show.
Yes.
But it's really, really important that people watch this, right? Because it's probably the best indicator of what's likely to happen ahead.
Yes. And one of the things that I've sort of said to, people who I have been speaking to over the phone and via email, etc., is how you prepare financially for stagflation or rising prices is very different to how you prepare for deflation.
Yes.
And so obviously I get inquiries about property, about a whole host of financial decisions, and obviously I can't provide financial advice. And I know people ask you, what should I do in this situation, that situation? I mean, the key point is that people need to understand what is happening with the money supply, the implications of this, and what it means for you at an individual level, and take the necessary steps to insulate yourself from the consequences of this.
Right. But whatever way it plays out, what we can say is there's going to be an ongoing income shock. Right?
Yes.
That's absolutely clear. High unemployment,
Yes.
right? More
underemployment.
More part-time jobs, more gig economy work, right?
Yes.
More firms going out of business.
Yes.
That's being reported at the moment, and I'm seeing it all in my data already. So the jobs numbers are going to look pretty sick for a long, long time.
Mm-hmm.
That means there's no possibility of income growth, right?
Mm-hmm.
I actually think income is going to go the other way.
Yes.
So even if you take the CPI numbers as honest, which they're not, right, people are going to get squeezed.
Absolutely.
Right? If in fact CPI is actually understating the reality, as my data suggests, people are already being squeezed. That's why we've got mortgage stress now at 40%. Right?
Yes.
Because that's the cash flow looking at everybody's income and expenditure, including mortgages, right? And what that tells me is that we have a whole pile of distress here, right, which has got to work itself out. And if in fact we get the stagflation scenario, where effectively, prices run up as well, then it just creates an even worse situation. So this is a big deal.
Yes. Perhaps 2 points. I mean, the first one is that you said that your view is that pre-COVID people were being squeezed.
Yep.
My contention, based on the distortion of the CPI and what we're seeing with in terms of the money supply, I think that squeeze will actually intensify.
Yes.
Going forward.
Yes.
We'll see more. Not only mortgage stress, because I think there was a presentation on your Walk the World channel the other day in which you talked a lot about rental stress.
Yes.
Do you want to just
Sure.
elaborate on that point?
So I've developed my stress modelling further, right? So I now look at mortgage stress. So it's all based on a cash flow analysis,
Mm-hmm.
money in, money out, right? So people with mortgages, have they got enough in the kitty to be able to pay their mortgages? When they haven't, or if they've got difficulty, they're in stress. I do the same on rental, and rental stress is now higher than mortgage stress,
Yes.
right? I also look at property investor stress as well. So
Mm-hmm.
these are people who hold investment properties, right? and are struggling because the rentals are not coming in, or they've got a vacant property, or they're trying to actually deal with the fact that their mortgage still needs to be repaid and they can't afford to do it. So whichever way you look, across all three dimensions now, which I report every month, there's more stress than ever across all three dimensions, right? So that is why I'm saying the pain in the community is huge, and it's whether you're a property investor, whether you're a renter, whether you're a mortgage holder, and it's only partially offset by the recent stock rises. So there are some people who feel a little bit more affluent now because of the stock markets being at their peak. They may come back, but we'll see. But this is a world of pain. Yes. And so this is a really important conversation, because I think people need to understand that this is not going to get fixed. We're not going to bounce back and suddenly everything will go back to normal, right?
That's right.
This is the new normal.
Yes.
And that's a scary thought.
Yes. Although, I think it's like a lot of political figures have been using this term, the new normal, and I received a video the other day where people were suggesting some sort of conspiracy theory about that language, about the new normal. So I want to reassure
no conspiracy here.
Yeah, I'll reassure the audience that North and Adams are not involved in sort of any sort of elite conspiracy around the new normal. But yes, we're not going to go back to where we were in terms of at the beginning of the year. Yep. So to wrap up the conversation, Martin, I think it's, the point I wanted to make in this episode was, if you think we have deflation, we do not. If you think we have low inflation, we don't have that either. Yep. A lot of our audience knows they are getting squeezed, so they don't need us to tell us, and they don't need the media to tell them that there's no problem. People can feel it on a daily basis, and obviously they're telling you via your surveys that there is a problem. And obviously, I told people a month ago we're going to head towards stagflation. I think this growth in the broad money is the leading indicator to say that what I said a month ago will come to pass. Now, obviously, things can change in terms of policy settings, in terms of a whole host of international factors. We're just about to go into stage 4 lockdown in terms of Victoria. So there's a whole host of things related to COVID-19 that could change the paradigm going forward. But we're not going to escape this issue of this growth in the money supply. And obviously this is the key reason why we have cost of living before and after. And I'll probably just close, because some people haven't come to grips with what this means over a historical time frame. Had you bought an ounce of gold in the year 2000, you would have paid roughly about $250 Australian for that ounce. Today, you're paying about $2,700, $2,800 an ounce. Now, in 20 years, the price of gold in Australian dollar terms has gone up 1,000% roughly, or even just a little bit above. So most people would say, well, gold is more valuable. That's the wrong answer. It's not that gold has increased in value. It is that the Australian dollar has lost value, and it is because of this growth of debt, growth of credit, in terms of the money supply, all the things we've been talking about in terms of the last 3 years. We are seeing an intensification of this process now in terms of fiscal monetary stimulus right around the world. And obviously this is why we've seen gold and silver prices go up the last about 30% over the last month. And obviously there are predictions that will continue because of the policy response. And so obviously the policies can change, and we could see a change in gold silver prices, but also in terms of what is the cost of living situation in terms of businesses and households. So we'll have to see, but based on the data that I see, we are in stagflation. We are seeing it right before our eyes, and I think it's going to intensify as we go towards Christmas.
Yeah, well, I appreciate that, John. Thanks for your time today. Very important episode. We will put a link to the earlier one where we actually specifically discuss money and how the value of money works.
Yes.
Because I think people probably should go back and revise that, because that really is the essence, isn't it?
Absolutely.
Thanks for your time today, John.
Thank you.
Martin North, John Adams, Interested People. We'll see you next time.